This video is a follow-on from the previous 28 videos dealing with price in the precious metals market. If you haven't seen those videos, I'd recommend you doing so before watching this one. In this video, I'm going to talk about hyperinflation some more. I'm going to focus on store of value, and I'll draw an analogy to help people better understand the velocity of money. But before we go any further, an important distinction needs to be made between money and currency. Most people, myself included sometimes, use the terms money and currency more or less interchangeably, but technically they are different and so shouldn't really be confused. But this distinction is not just a matter of semantics. There are real-world ramifications that everyone needs to be aware of. The most important difference between money and currency has to do with store of value. Precious metals such as gold and silver are considered as being money because they have the aforementioned store of value. This means that both gold and silver hold their value over time. This is one of the most important characteristics of money, and it's especially important in terms of facilitating trade. I've talked about this elsewhere, so I'm not going to go into great detail here. All I will say is that it's absolutely critical that money retains its value from the time that someone accepts some money to when that person wants to buy something in, say, a store. Indeed, it's vital that money retains its value no matter what time period, be it short term, medium term, or long term. I think it might help to draw an analogy, especially for those who are more visually orientated. So, you might want to imagine a bucket with water in it to represent money or currencies and the notion of store of value respectively. Imagine a scenario in which a farmer fills the bucket with water. Then he has to do something on the farm that needs his attention, whatever that might be. But when he returns to the bucket, sometime afterwards, he finds that his bucket is nearly empty. Why? Because the bucket has a hole in it. I would say that a bucket with a hole in it is pretty useless and really needs to be discarded. Basically, it's not fit for purpose. This leaky bucket analogy should help explain the crucial difference between money and currency in respect of store of value. Money acts as a good store of value, while currencies do not. I should, though, qualify this statement. With a gold standard, currencies can act more like money because the gold backing them ensures that they can be a good store of value. They can act as a reliable money substitute. They can be almost as good as gold. I say almost because currencies will never ever be real money. In and of themselves, currencies have no inherent value. The leaky bucket analogy can also help us gain an understanding of what happens during a hyperinflationary event. I think this is best explained by means of another imagined scenario. Imagine that I have a job in a factory. I work 35 hours per week. I get $2,000 per month. Let's assume that I get given my salary at the end of the month in the form of cash, as in days gone by. So I get paid in the physical form of currency rather than the salary being transferred electronically, deposited into my account in the form of digits on a screen. At the end of the month, I get given a number of notes in an envelope by the company clerk. Let's also assume that today is payday. I go into the office and collect my salary, my envelope of cash. We must bear in mind that the payment I receive on a monthly basis is recompense for my labour. So we can say that the currency that I'm holding in my hand as I walk out of the office, the physical cash, represents my labours, my time and energy for the previous month's work. To put this another way, we can also say that the value of my labour is stored in the cash. My labours have been magically transformed into physical cash. I can then take that cash to buy products in a shop or to pay for various other services, to pay my mortgage, to pay my bills, whatever the case might be. So essentially, this store of value facility enables me to distribute the value of my labour into the economy, the marketplace, as is necessary or as I desire. If I'm lucky, I'd have earned enough to cover all my monthly costs and I'd have bought what I want. I could then put some of it away somewhere for safekeeping to use sometime in the future when I need it. I could put it in a savings account in a bank. In this particular instance, it's vitally important that it holds its value over time. All well and good, you might say, but what happens if the currency that I'm holding is not backed by gold, and so is not a good store of value? Or even worse, it's losing value at a rapid rate, as happens during a hyperinflationary event. Well, I have to rush out and spend it before the value drains out. I know that if I wait too long, all the value will be gone, and then my labour, the time and energy that I spent at work, is totally wasted. All that I'd be left with would be a bunch of worthless notes, pretty printed pieces of paper, or to put it another way, in accord with our analogy, an empty bucket. This should explain why, during a hyperinflationary event, people spend any currency that they have as fast as they can, because they know that their currency is losing its value. So they spend the notes as soon as they can, or while they still can, buying whatever they can, whatever is available, in order to convert the devaluing or depreciating currency into some kind of hard asset. People operate on the principle that it's better to spend as soon as possible and buy goods, things of real value, rather than hold on to increasingly worthless currencies. Et voila! The velocity of money speeds up in a hyperinflationary environment. I hope that this imagined scenario shows how vitally important it is that money not only retains its value, but retains its value over time, and also how important it is to back a currency with something which has value. In the past, this has been gold and silver. If you want to have a better understanding of inflation that we're experiencing, it's worth thinking about hyperinflation. Hyperinflation helps illustrate the pernicious effects of inflation very well. The adverse effects of inflation are brought into stark relief when we look at what happens in a hyperinflationary event. I've split this topic into a number of videos, so there's another 1 or 2 to follow. In the next video, I'll talk about hyperinflation some more as it relates to precious metals. In the video after that, I'll give some real-world examples from history. Wise up and rise up.